You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, thanks for tuning in to another episode of QSBS Solved. We want to continue bringing quality content that applies to founders and folks who are involved in early stage businesses. And one area of that could be valuation, either at the early stage of a company, maybe around a funding round or M&A activity. And that is not a focus of our firm, so we wanted to bring in some experts. I'm here today with Mr. Dan Eyman of Meld Valuation. He's going to share a little bit more about what valuation service providers do, what his firm specializes in, and what that means at a point of time in maybe a founder's journey or the journey of a startup. So good to have you, Dan.
Yeah, thanks for having me, Brady. Excited to be here.
Yeah, obviously we do QSBS. We've talked about QSBS together. Give us a high level overview of what valuation might mean. First of all, just what is valuation? Why would someone employ an outside service provider to get a valuation for a company? And then we can start talking about the point in times where it might cross over with qualified small business stock considerations.
Yeah, absolutely. Well, in terms of valuation, obviously or maybe not obviously, what we're doing is we're valuing the company and then the underlying securities within that company. So oftentimes with startups, they may have many classes of stock. So they have common stock, maybe Series C, Series A, Series B. So the first step you do is you value the company as a whole, right? And then you allocate the value to the different classes of stock, because different classes of stock have different rights and preferences, which have different values. Oftentimes, startups and companies, as a valuation firm, I'm foisted upon you by an auditor or a lawyer. You don't always know that you need a valuation. It's not as simple as just saying, "Oh, we're worth our post money." Well, it's not that simple, especially when it comes to tax and trusts and estates. At the early stages, I think most founders are familiar with 409A valuations. That's a valuation you get to issue stock options. There's lots of good providers out there. We do them, and you can also get them through cap table providers like Carta. As far as gift and estate, oftentimes, especially at the early stages. So for an early stage founder, the 409A and the gift and the estate valuation are done sometimes in tandem, and because technically, the valuation mechanics are going to be the same, especially for early stage companies. But what the IRS is looking for when it comes to, say, a gift and estate valuation, and in this case, when it comes to QSBS, is very different than what a 409A will look like. And I'm not talking technically on the quantitative side, but what's in the report, how that report is structured. There's a letter that's attached to these reports. The IRS has been very specific about what they want to see. So, if you're an early stage founder and you're talking to a valuation firm that does not know what goes into those reports or what that letter should look like, you probably need to go the other way.
Right. So it's more than just finding a number or pulling out a number and saying, yeah, we did our work on this. There's specific criteria for justifying how you got to that number and how you document that. And you're talking about, the IRS has laid that out, correct?
Oh yeah. They've laid it out very specifically. And, let's imagine you're an early stage founder. You qualify for small business stock, right? You do all the work, and everything goes swimmingly. And 5 years later, you exit and you get a great exit for yourself personally. Well, guess what? The IRS wants their money. So they'll probably take a look. And the bigger that exit gets, the more likely they are to look and audit your situation specifically. So, winging it is not the way to go. I would say that most You don't listen, if anyone's dirt cheap in terms of this world, go the other way. But that doesn't mean you have to spend an arm and a leg to get it done.
So say we have three founders, maybe they're friends from college. They've been messing around on some, maybe a software product, and maybe they've made varying levels of contributions. Maybe there's even like some kind of MVP that they've been messing around with, and they say, hey, let's see if we can create a company out of this. Let's formalize some things. Is that a point in time where a valuation is necessary, even if they haven't even brought in any capital, just to sort of justify like, this developer is bringing with him this set of resources and skills and has built this product, and maybe that product is worth $5,000. I don't know. Does any of that matter or count, or, are we that's a little too early?
It's a good question, and it kind of depends on the industry you're in, to be honest. I mean, because there's startups that go public with no revenue. Case in point, biotechs. That's the whole model. There's startups that won't have revenue for a long time. Maybe they're very complex in what they're doing, on a technology basis, and what they're doing has value, but maybe they're not a ways away from revenue. Yes, to answer your question, you can bring in a valuation firm at that time. I would say, in terms of what we're talking about, you want to bring in a valuation firm before you go raise a price round, right? So before the money's in the door, because once you go raise a price round, well, we know the price. Someone just paid it.
Yeah.
So in terms of, QSBS and gift and estate, before most companies are doing safes, these simple agreement for future equity these days. And that is probably a conversation for another time, but they're getting money in without having to price it before they go do a price round.
Yeah. So before a price round, and then possibly again in the future, if there's an M&A transaction imminent, talk about the triggers for that. At what stage in a process, if a company is starting to explore, what sort of comes first in that order?
Yeah, well, I mean, definitely I've done valuations pre and post M&A. Sometimes on the post M&A, it could be legal issues, like they're moving shares in and out of trusts. It could be a gift situation. I did a very large gift to a religious organization of all things. This founder wanted to make, and so we were valuing the shares post M&A. And then pre M&A, it may, sometimes CEOs, founders, whoever, even if you get a large grant that vests or something like that, immediately they may wait to do estate planning, and so maybe they're like, hey, it looks like we're going to be able to raise our B. We're seeing lots of great traction in this market. I think we're going to be heading for an exit eventually. I'm going to start to think about estate planning, right? And sometimes they end up talking to you, right? Because they may exit before that 5-year holding period, even though the laws have changed just recently. So they may want to do a rollover. So there's lots of different touch points at which I've worked with founders in terms of gift and estate valuations. And it just depends on each person's situation and when they, think about it. I mean, at the early days, you've started a company, I've started companies, like you don't think about this kind of stuff when you're just trying to get off the ground and get $1 in the door. But it does become an issue later when you're like, looks like I'm seeing some success, like maybe I should start to think about things like these. I don't know. I'd be curious to hear your experience in terms of like the touch points at which you work with founders or company executives.
Yeah, I mean, QSBS definitely is in that category of things that people often just don't think about until, sometimes until it's too late, but oftentimes just to the point where they have a million other balls up in the air, and they're like, man, I'm trying to close this deal. I'm trying to close this funding round, trying to get this M&A done, trying to sort out my personal finances. Oh, now tax. It's always not that there's ever a like down period, but it's good to take care of some of that stuff before it's crunch time. And so hopefully we make that easy. Obviously, hiring someone outside on valuation takes a lot of burden off your plate. But who I guess often starts the conversation? Is it a founder coming to you knowing that this is what they need to do, or is it maybe they're working with a CPA or other service provider who's like, hey, it's time? Is it a VC sort of prompting them? What's your experience?
Yeah, typically it's a CPA or an attorney that's working with the founder. They will send them over. I mean, often the founder doesn't even know. I mean, I'm surprised how many founders don't even know about QSBS.
Sure. Yeah.
It's just, I mean, it's free money that you're leaving on the table.
Yeah.
If you don't take advantage of it, it's,
we think our like little estimate internally is like $15 billion a year.
That's crazy.
And so, I mean, you can come to a bunch of different guesses, but that's ours. So
that sounds about right. I mean, one way that I've worked with founders too is, especially early stages, let's say seed, Series A, Series B, founders may not have a lot of money, right? They may just be getting their salary from the round they raised or something like that. But the company be willing to pay for a 409A, right? So what we'll do is we'll say, because like I said, quantitatively, the work is pretty similar at the early stage in terms of the quantitative output, right? So we'll say, listen, we'll do the 409A for X dollars, and we'll include the gift and estate tax valuation, right? This way it takes because they can get expensive, and if you can have the company pay for it, well, then that's great, right? It takes the burden off the founder. Oftentimes, founders, when they do typically Series B, Series C, they're doing secondary sales of their common stock, so they're taking money off the table. So then they can afford it. But often at the early stage, what I tell founders is, have you done a 409A? No. Okay, well, we'll do your 409A and include the gift and estate portion for you for free, because it's essentially just a different report and a different letter
stuff that
I write.
Exactly.
Yeah.
Yeah, that makes sense. I mean, you said that a lot of people come and don't even know, just don't know where to start, I guess. What's maybe, and if this is the wrong question, let me know, but what are the one or two things that people come to you and you just hear over and over again that they ask, or maybe even something that they have wrong that they assume was correct that just isn't, and you have to sort of set them straight in terms of their understanding? Is there anything like that you come across all the time?
In terms of valuation?
In terms of valuation, yeah.
Oh, not understanding that, because a post money or a pre money just assumes all the shares have the same value, right? I mean, you just take whatever your pre money is, say 20 million, and you divide by the number of shares.
Yeah.
Well, preferred shares have a lot more value because they have liquidation preferences, i.e., you get your money before anyone else. They have conversion rights.
Yeah.
Typically, they come with board seats. That's not something a common shareholder typically has. I think the two questions I get all the time from early stage founders is, how much is it going to cost and how long is it going to take? They're moving fast. They're moving at light speed. And just, I think there's just not a lot of great understanding of valuation approaches in this world, right? Either they think, especially if you live in a real startup centric hub around this country, they just hear the numbers flying around and they think, well, because I'll ask people like, well, how did you come up with the valuation cap in your safe? I don't know. I just pulled it out of thin air.
Yeah, sure.
Okay. Yeah, that's great.
Yeah, there's also just the word value, like XYZ company is valued at this amount. I mean, I don't think your average person really knows what that means at all. I mean, in the public markets, we at least have share price, but some people have no idea what the valuation of a company relative to its share price means, like how they get to that number. People don't understand outstanding stock, shares issued, like any of that stuff. So I think the average person is just, the language of it all is behind, and founders maybe are only a notch further ahead in a lot of these conversations.
Yeah, absolutely. And the true test of a company's value are public markets.
Right.
I mean, I can't tell you.
Highly liquid. Yeah.
Yeah, I can't tell you how many times I've been doing valuation work for 17 years, and I can't tell you how many times I've seen down rounds.
Sure.
Company gets ahead of itself. They're like, well, our post is, just pick a number, 5 billion. Like, okay, but your revenue is only X. So you're what? You're trading at 30 times revenue? Oh,
You have to keep up some pretty good pace. Get up.
That wouldn't fly on the S&P 500.
That's right. Yeah. What's Google at like 19 right now? Nothing like that.
Well, Tesla's a good example. The average S&P 500 company trades at 25 times price to earnings, right? And we're talking Dow Chemical, P&G, good companies.
Yeah.
Tesla's trading at 180 times price to earnings.
Yeah.
And that's all a lot of that is from their charging stations and financial engineering, buying Bitcoin.
Yeah.
Yeah. So anyway.
Yeah. I don't know if you've done any work on MicroStrategy, the company that's just basically a Bitcoin treasury. I think that's probably a field day for people who are nutty about public company valuations.
Oh yeah, they're always a comp when we work with crypto or tokenized assets. Yeah, for sure.
So you do both do work in public markets as well, or really just the private markets? What's kind of or is that not the right way to?
No, that's the right way to think about it. I mean, almost all of the work we do is in private markets.
Sure. Now are there other firms, I guess, that only do public and?
Yeah.
Yeah, sure.
Yeah. I mean, once you get to the public level, unless you're, like I said, like a biotech or some kind of specialized company, you have people internally that.
Oh, sure. Okay.
And the rules change as soon as you go public for certain things. So.
Yeah. Okay. I think something we run into, because we cast a pretty wide net in like the startup and QSBS space. We talk to people all the time who, are very early with their company, and they're saying something like, hey, I'm about to raise a funding round. Or we just want to make sure everything's set up properly from the beginning. Is there anything that a founder can do before they call on you that makes the point in time in which they do call on you easier, like operationally, logistically, or is it kind of you guys are set up to handle a company at any stage and at any level or lack thereof of documentation and formality?
Yeah. Well, the latter. I mean, we're set up to work with anyone, and I've done everything from companies that I had a Y Combinator founder ask me, what's a balance sheet? I said, oh boy, you're going to get replaced as CEO real quick. I would say be a grown up. Like
Sure.
Doing your housekeeping's not fun, but have your books in order, have your cap table in order. And if you need to be on a platform for that, do that. I know it's not fun to spend money on those, but just do it. Because once you get to me, if you have all that stuff in order, it's going to be seamless and quick. You're not going to have to spend a ton of time.
You get to raising money quicker too, then, right?
Oh, absolutely.
Things in order. So
investors, they want to see good housekeeping, right?
Right. Yeah.
I'm of the personal opinion that early on you don't need a cap table software. If you
Excel will do. Yeah.
Yeah. I mean, it's something static that gets pulled out a couple times a year. And as you grow, you can merge and get a cap table provider. Like, there's many of them out there. You can just Google it.
Yeah, if it's just you and your college roommate, you don't need Carta right now, probably.
Yeah, or even if it's just 10 names, right? Like you don't need it. And I think most of the platforms have like free versions.
Sure. Yep.
Like that I've seen.
Yeah, Carta, don't come after us. There, I'm sure you have our
Carta, Poly, Mantle, Cake Equity, EQ Vista. All of them, they all have kind of free versions for early stage people. But
yeah. And obviously, hopefully that people who are in need of valuation work consider you guys and come over. But obviously, there are folks all around the country who can do this work to a high level. What should someone be looking out for? Is it really just price and speed that differentiates? Or can you talk to me about, when someone's choosing who they're going to work with, what comes to mind, and what kind of, what do you guys try and put out as differentiators for your business?
Yeah, I guess I would say price and speed are the two questions I get all the time, but that doesn't necessarily mean those are good things. there's plenty of cheap providers out there. They're not good.
Sure.
And in some of the valuations that come out of certain places who shall remain nameless, but you know who you are, they wouldn't stand up to audit scrutiny.
Yeah.
You can't apply 60, 70% discounts for marketability onto a common share.
Mm-hmm.
It's a huge red flag for an auditor. It's going to give them heartburn. They're going to say, what's that? And that goes both on the fund side as well, but that's not for a conversation for here. But, I would say what they should look for is experience.
Mm-hmm.
And I know that may sound cliche, but, and who they're actually going to be working with, right? You may talk to someone who knows what they're talking about only to be handed off to someone who doesn't know what they're doing. And then that person may never see it again. What I tell people is that you get Big Four quality without Big Four price here. We're particularly adept at valuing complex assets. So things that are hard to value.
Mm-hmm.
We're technically very, very good at what we do. So, I mean, those are the things that I would say you look for is that, you can ask around and, listen, 409As, just to worry about this, like 409As will not get audited by the IRS. There's no one to audit them.
Mm-hmm.
They have a huge backlog in terms of their tax department, but they will get audited when you go do a Series B. And that Series B investor says, we want you to get an audit every year from a reputable firm. They're going to go back and they're going to look at your previous 409As, and you may have to redo them. I've redone other firms' work because they were so bad.
Yeah. Which I'm sure is more expensive than doing it right the first time.
Yep.
Yeah.
Yeah. And if you're like, well, we're trying to close our audit in a week. Well, guess what? It just got more expensive.
Wow. That's right. Yeah.
So,
Yep.
I can't name names, but there's definitely firms out there. Listen, if they're doing it super cheap, there's a reason.
Sure. Yeah.
Yeah.
Yeah. I mean, I think that anyone who runs a service-based business or can understand that dynamic exists in every market. So that's a good word to pay attention to.
I mean, I think one last point is that to ask where it's going to be done, because there are definitely valuation providers who say, oh, we can do that. And they send your data without you knowing over to India. Mm-hmm. And the valuation's done there. Or they send it to Southeast Asia and the valuations are done there without you knowing. So ask where it's going to be done. Ask where your data is going to be kept and if it's going anywhere.
Who you're working with, how long they've been doing it, what you're getting for your money, and where that work is being done. Those are good things to consider. That's great, Dan. Thanks for the overview. I think this has been helpful. Hopefully we kept it on a level that was like no dumb questions version.
Not at all.
I'm new to this, so hopefully our listeners also maybe got a little bit of value.
I hope so. No pun intended. I hope they got some value.
Yeah.
Nice. I'm curious to hear from you. What kind of, are you getting any inbound interest in terms of the changes to the QSBS laws with the passage of the quote unquote big, beautiful bill?
Yeah. In the days right after it, we had a lot of follow-ups with people who maybe were kind of in the funnel and dropped out of it because, they didn't qualify for our services at the time. But then kind of got back into the conversation because we were exploring what some of the near-term, opportunities could have been. It seems like at this point, we're not going to see a ton of folks who fit under the new rules until maybe 12 to 18 months out from now.
Yeah.
And now there's certainly, for instance, employees at companies who are exercising ISOs who this could apply to right away. But for founders of companies, it's really, hey, was your company founded after July 4th to fit into that? And so the point in which they would typically start talking to us if they have a really early exit or a priced round pretty early on is probably going to be 12 to 18 months after. I have talked to, in this sort of AI bubble that we're in, we have talked to people recently who've had full an M&A at less than 12 months.
Mm-hmm.
Company getting bought up, kind of, bolting on smaller companies into larger AI businesses, or, pick your business that wants to be tech forward and just kind of grabbing up a tool. And so I think we're seeing a lot of early exits right now. We're seeing a lot of large fundraisers happening earlier on. For instance, like, $100 million Series A at, 2 years in.
Yeah.
So yeah, I think that as long as that continues to happen over this cycle, I don't know where we're at in the sort of AI cycle, but it feels bubbly, but it also feels very early at the same time. So yeah, I think as long as that continues, we'll start seeing more people fit into the new rules over the next 12 to 18 months.
Interesting.
So we were just talking about it today. Had a panel where we were going over the rules, and I think the most interesting one at the onset is that companies will be qualifying for QSBS longer because the gross asset test was moved from $50 million to $75 million. And if you take the median funding amounts per round, if you go seed, Series A, Series B, it's like $53 or $56 million, which would typically mean under the old rules that after Series B, any stock issued was probably no good. Now, that's sort of anecdotal because the company was probably burning cash before that, and so maybe the numbers didn't match up. But the point is that more often now than we were in the future, you could see QSBS being issued at Series C and beyond in ways that, might just have not been really possible before. So it's kind of interesting.
Absolutely. I also think the tiered gain exclusion is interesting, the way they've done that. So
yeah, if really there's a path forward for people to take advantage of QSBS at any point that they exit, if they're under these new rules.
do you want to explain that? So
yeah, sure. Yeah, so one way, or the most straightforward way, is under these new rules, you can exit at year 3 or at year 4. Previously, you would have had to hold till 5 years to get any benefit, but at year 3 now there's a 50% exclusion rate available, and beyond year 4, 75% exclusion. And so there is some benefit even exiting in those timeframes. Now, if you tack on the opportunities that our firm provides through QSBS rollovers, for instance, the founder that we've spoken with recently who exited before a year, now they were under the old rules, but if they were under the current rules, there'd be a very straight line pathway for them to do kind of a strategic rollover and get to some level of gain exclusion based on getting to 3 or 4 years. So it opens up the optionality that people have to do strategic planning. It increases the number of companies who will ultimately be issuing QSBS. It expands it, is the easiest way to say it. And it's really cool because now we've seen expansion back in 2010 and 11 from the Obama administration, a Democratic mainly controlled Congress at that time, and now the opposite under the Trump administration and a Republican Senate and House getting it through. And so seems to be bipartisan support, doesn't seem to be going anywhere, which is cool.
Yeah, no, I think it's really founder friendly, investor friendly. I think it's a good thing.
100%. Yeah. And so hopefully, as we continue to expand our footprint and talk to more founders over time, we'll be able to refer out folks earlier in the process to people like Dan, CPAs, attorneys, other folks who can help out beyond the QSBS and rollover related services that we provide. Because again, you guys are the experts on those niches, not us. So glad to have you on to talk about valuation, and hopefully it was a good starter blueprint for founders to think about next steps.
Yeah, thanks for having me.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.